Ladies and gentlemen, good morning and welcome to the Suprajit Engineering Limited Q2 FY24 earnings conference call hosted by Anand Rathi Shares and Stock Brokers. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Mumuksh Mandlesha from Anand Rathi Shares and Stock Brokers. Thank you, and over to you, sir. Ladies and gentlemen, the line from Mr. Mandlesha has got disconnected. Please stay connected while we try to reconnect him. Ladies and gentlemen, thank you for patiently holding. We now have the line from Mr. Mandlesha reconnected. Sir, you may please proceed.
Yeah, thanks, Lizin. Happy Dhanteras and Diwali festive cheers to the management and participants. On behalf of Anand Rathi Shares and Stock Brokers, I welcome you all to the Suprajit Engineering Q2 FY24 conference call. I thank the management for taking time out for this call. From the management side, we have Mr. Ajit Kumar Rai, the founder and chairman, Mr. N.S. Mohan, MD and Group CEO, Mr. Akhilesh Rai, Director and Chief Strategy Officer, and Mr. Medappa Gowda, CFO and Company Secretary. I request Ajit sir to give an introduction review about the results, and then we can follow up with the Q&A session. Over to you, sir.
Yeah, good morning. Thank you, Mumuksh. Good morning, everybody. And again, a happy Diwali and Dhanteras. Thank you for joining us on our Q2 and first half results Concall. We will start with some initial remarks from our team, and then we'll take on questions. We'll start with Mohan, our MD and CEO, followed by Akhilesh Rai, and then by Medappa. So I first hand over to Mohan. Go ahead.
Thank you very much. A very good morning, and wish you all a happy and a prosperous Deepavali and Dhanteras. As usual, what I will do is give you a market and general business update first, and then take you through the individual units. In India, as you know, the passenger vehicle segment did well, but importantly for us, the two-wheeler segment is still struggling. And very specifically, the entry level and the commuter segment is still not yet out of the woods. Potentially, the failure of monsoon could have had this effect, but however, even in October, it hasn't been great, and this was probably due to the Shad period, and I really feel that the festive season will kick in some amount of good news. November shows some potential, and we are seeing OEMs are pitching a lot in the market. Now, moving away from India market and into the global markets, some of you would have noticed that in the previous call I wasn't there. I was in US and Europe for about 2 months, and in fact, I met quite many customers apart from visiting our plants there. Let me start with the US market, and again, within that, let me split it into automotive and non-automotive market. Automotive market was hit by the UAW strike, and again, thankfully, it's behind us now. But having said that, I think it did leave a scar on our business. Non-automotive segment has taken a very severe hit due to a combination of reasons. The housing market, high inflation, high interest rates has had this impact, specifically on discretionary spendings like lawnmower and power sports vehicles. A severe summer conditions did not aid either, and it did not foster the sale in these segments. I expect this effect will be a bit prolonged in the non-automotive segment in USA. Moving on to Europe, Europe is still yet to recover and settle down the post-Ukraine war scenario. And the further stability in this region hasn't helped either. However, we continue to win business in the European region, and I think it's great news for our business at SAL and SEU. In China, one specific customer who is into non-automotive got hit due to restriction in sale to Russia, and that has impacted us along with the relocation that we are right now in the midst of. So having said this general update, let me move into specific divisions, and I will start with our Suprajit Controls division, which is basically all our operations outside of India, except for, of course, Luxlight. Our turnaround at SCD is taking more time, and it is facing some headwinds, primarily due to the economic conditions, like customs tariff, wage increases, interest rates, and so on and so forth. However, our restructuring and assimilation exercise has been on schedule, and the MAX teams, which we had initiated across all the territories, are coming together and bringing in synergies. Specifically talking about Lone Star, China, we got a new plant head, and Shanghai Lone Star is facing this relocation, as I mentioned, causing some significant one-time and double expenses like rentals. And it is also a double whammy with slowdown in the non-automotive business there. At Schiofok, that is Hungary, we have identified parts which have been stressed on profit, and we have started bringing it to India, as it still makes overall good business sense for us. As mentioned earlier, we continue to clock new business wins at SEU. And am I audible?
Yes, you're audible, Mohan.
Yeah. Okay. And our concept of the front end in Europe with a back end operation in India is getting accepted well. I think it's a very good news. In fact, I was in front of a couple of customers, and I think it is really gaining traction. I think the track record that we have had is helping us to locate these low margin products out of Europe into a sale, while we still continue to look for high value adds at Europe. In US, we successfully completed the transition of a third-party warehouse, it was called a PMI warehouse, to our own existing warehouse at Brownsville. So it brings in a lot of economic synergies there. We are also in the process of moving a lot of plastic injection molds from a third-party vendor who used to supply to Westcon, and bring this in-house at our Matamoros plant, and this obviously will improve the economics. So moving on to the Phoenix Lamps division of the PLD, we grew business despite the continued LED penetration, and very importantly, the margins improved and went into double-digit levels. I'm glad to say that this efforts both at the plant level and also at the business development level have yielded this kind of results in improved profitability. You may recollect that the EBITDA had dropped, and we had put together a plan to get to the double-digit level. Division's restructuring continues at Luxlight and Trifa, and Trifa liquidation is expected to be concluded by Q4. Moving on to the domestic cable division, we continue to retain our strengths in the form of our DCD. EBITDA remains stable. Our focus is clearly to go beyond cables and beyond two-wheelers in cables, and these efforts continue. With this, I complete an update on the controls division, cables division, and lamps division, and I would like to hand this over to Akhilesh to talk about the other areas. Over to you, Akhilesh.
Thank you, Mohan. So I'll start with the electronics division. As you know, it is the organically launched division that was only launched this year. I'm happy to say that it has made good progress and clocked very good growth. The teams at the plant have been working literally 24/7 to manage the kind of growth we've had there. You can see in our disclosure that Q2 or Q1 was almost 150% growth in sales. We're also happy that the division turned EBITDA positive in Q2 with just 1 year of operations and, as you can imagine, pretty high fixed costs. The division started deliveries of actuators for 2 of the large EV two-wheeler customers, and I would say that the digital cluster business is only starting to ramp up. So we will see a lot more good, strong business in the coming year and in the short term. I'll move on to the tech center. This is, of course, one of the key parts of Suprajit and one of the reasons we were able to launch the electronics division. The tech center continues to change how Suprajit is accepted in our customers' eyes as a supplier beyond cables. We are in discussions on multiple products and in the late stage of a lot of the evaluations to start productionizing products across different areas. There's been a lot of interest shown by our customers in actuator systems, braking systems, and of course the digital clusters that I've already discussed about. Regarding the coming quarter, I think we have and the balance here, we see the challenges at FCD continuing, mainly because of the global challenges already explained. However, DCD and Phoenix Lighting Division (PLD) will continue to perform well. The SCD growth will continue as you see today. We continue to see this as one of the strong performers within Suprajit, and we're actively pursuing multiple infrastructural assets to house our beyond cable projects, which a lot of our customers have shown great interest in. The group is working on one ERP and one PLM initiative to bring all of us under a single ERP and PLM system. This will help us collaborate and find much better synergies across the group. We finalized the licenses with both SAP and PTC in the previous quarter. The domestic business for Q3 has been strong so far, leading to some optimism and expectation for a good second half of the year. But overall business will continue to be strong, and we have clear long-term visibility on good growth. With that, I'll hand it over to Medappa.
Yeah, thank you, Akhilesh. Good morning, everyone. We announced the financial results for the half year ended 30th September 2023. The consolidated revenue for the half year ended 30th September 2023 was 1,389 crores as against 1,361 crores for the corresponding period of previous year, a growth of 2%. The consolidated operational EBITDA for the half year ended September 2023 was 144 crores as against 136 crores for the corresponding previous year, recording a growth of 6%. The standalone revenue for the half year ended September 2023 was 719 crores as against 723 crores for the previous year. The standalone operational EBITDA for the half year ended September 2023 was 125 crores as against 118 crores previous year, recording growth of 6%. The total debt level was 629 crores as on 30th September 2023. The cash surplus balance was 517 crores as on 30th September 2023, invested in mutual funds and bonds. For any further queries, you may approach again directly also, even after this call. Thank you. Thank you all.
Yeah. Thank you all. I think I will leave my comments probably for little later. We'll take the questions as it comes. So I'll ask the moderator to monitor the calls and direct it to us, please. Thank you.
Thank you. Ladies and gentlemen, we will now begin with the question and answer session. Anyone wishing to ask a question may please press star and 1 on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is on the line of Abhishek from Dolat Capital. Please go ahead.
Thanks for opportunity. Sir, my first question on the cable business. So how's the outlook for the second half in the domestic cable business? And the second is what is the progress on the export cable business, that is for the four-wheeler side? If you can throw some light over there.
As for the domestic cable business, it will obviously relate to how the domestic industry will do. October, as Mohan has said, has not been greatly exciting, but November I see that sales seem to be picking up. So I would think that just the October sales for us has been actually much ahead of the industry growth as far as I see for the month, but that is not really an indication. But I do believe that the second half will show some decent growth because typically, historically also, this is the time of maximum sales during the third quarter, and generally Q4 is stronger. So I would expect H2 to be probably likely better than H1. In terms of four-wheeler exports, I think from SAL the growth has been very good. The dispatch from our Suprajit Automotive has been strong. The order wins have been strong. But what has happened is that the existing volumes have come down with the customers. Like all our big customers have sort of reduced the offtakes, and there has been certain postponement of the new launches. Although orders have been won, the launch dates have got postponed by 3 months, 6 months. Some of them have been even pushed by almost a year because of all the uncertainties across the world. So it's the issue of timing, I think. So having said that, I think SAL had a strong growth in exports of cables.
And the second question in the non-automotive segment, the Vascon and LDC is showing a weakness. So
yes.
Most probably when can we expect the revival in the volume as well as the bottom line both? And what kind of the capex you are looking on these businesses?
The non-automotive bottom line will depend upon the top line. The way we see it currently is that this and next quarter we won't see any much change. This is the feedback that we get. I think Mohan has also been, as he said, been visiting a lot of customers. The customer feedback is that, it's typically, let's say a lawnmower, simple thing, if the season, if it's too hot, there is no grass to mow. So people probably postpone the decision of buying a lawnmower from this year to next year. Similarly, if the snow season, with all the global warming, if the snow season is weak, the people don't buy, they postpone for another year. So I think the postponement is typically a year in the business that we are in. So if they're not bought this year, hopefully they will buy next year. So certainly next couple of quarters, we don't see much change, and it will affect Vascon, it will affect part of our erstwhile LDC divisions, and also exports out of Bangalore from our Unit 9. So this, I would say, at least from what I see, it is at least a 2-quarter phenomena, if not more.
So fourth quarter is always very much strong for the Vascon.
Typically, yes. I agree with you. Typically, yes. But I think this year, another reasoning is that, people buy these things also under EMIs, etc., right? So with the interest rate in the US today, mortgage rates, I'm just giving an example, of 7% and 8%, if somebody can afford to pay a mortgage, they will postpone everything else later on. These are all discretionary items. So that is what is happening. So I think this high interest rate is another reason where some of these purchasing powers have come down, and there is going to be delay. It is not a lost business, but I think it is a postponed decision as I see it.
Thanks, sir. That's all from my side.
Thank you.
Thank you. The next question is from the line of Viraj from SIMPL. Please go ahead.
Yeah, hi. Thanks for the opportunity. Just a couple of questions. First is on the Suprajit Control division, right? Now, if you look at the overall sales which we did last year, around 13 to 49 crores, so the business largely has...
Sorry, I didn't get that number. What are you saying?
So if you look at the overall sales which we did of the entity last year, around 1300 to 1400 crores, so business largely has 3 parts. One is the automotive export, which happens to SAL. Then you have the SENA, which is non-automotive part, and then the erstwhile LDC. Can you just give some more detailed perspective in terms of how the customer and the segment concentration is in each of these businesses. So to give a perspective in Westcon, what when we acquired, it had a very high concentration in one or two sub-segments, within the agri off-highway segment. But fast forward 2023, how has that changed in terms of the overall business mix? And based on the order wins which you have, how that is supposed to change over the next 2-3 years. So any perspective you can give on customer and segment concentration in each of these businesses?
Yeah. Let me make a general comments on all the 3 points, that three subdivisions within that, I would say. The SAL and SEU, Suprajit, Europe business is pretty strong. That model of front-ending from, Europe and some extent from US and manufacturing out of India has been really hitting the sweet spots with the customer. So we have been winning significant new contracts at very good margins. So that part of the business is doing strong. Now, with Sena is the one I would say is most affected at this moment because there's purely non-automotive business. The reason why, of course, the controls division has not grown is largely because of Sena, because there has been a degrowth at Westcon, there has been a degrowth at Unit 9, Unit 9, where we are manufacturing non-automotive cables because of the reason that we have said. It's in the power sport vehicles, it is in the outdoor power equipment. All those are discretionary, purchases. That is where the significant degrowth is there, which is why overall, although actually LDC, if you put separately, they had some decent growth, but when you're putting them together, I think, the overall growth has been, very marginal or, flat. So that is in the individual basis.
And when it comes to, say, LDC or even the Suprajit Automotive, in terms of customer concentration, how would that pan out? I mean, you talked about the top 3 US.
Yeah. I think the customer, one thing good about it, they're all complementary customers. We didn't, the LDC purchasers didn't, except in 1 or 2 pockets, there has been no overlapping of customers. I think that has not been an issue. The big customers today are still, I would say, the top customers for us is BMW, Volkswagen, John Deere, couple of these North American, of course, through Tier 1, Tier 2, and directly, Detroit customers. I think they are the big, let's say, top 5, and of course, Tesla is also a big customer. So these are, I would say, the top 5 customers in that.
Okay. And in terms of the second half, especially X of the non-automotive business, do we see further deceleration in terms of the overall? I understand there will be some impact because of in October because of the strike in US, but I mean, adjusting for that, do we see any further deceleration in the overall sales or the new?
I think, Q3 will have some impact because what has happened is that October has been badly affected because of this UAW strike. And the restarting has also been happening little slowly. Basically, we have lost almost like 7 weeks or maybe even 8 weeks. So to that extent, certainly there will be an impact in Q3. And Westcon also will be weak in Q3 as well. Q3 is typically not a great month for Westcon in any case, historically also. So that gets further accelerated. But I think then I would say that probably Q2, Q3 are the tough quarters for us. I should see some change hopefully in Q4 unless, market itself decelerated for whatever reason in Q4.
Okay, just 2 more questions. One is on the, again, Suprajit control division margin. We did something like 3% EBITDA margin. And if I look at the subsidiary level, adjusting the console from standalone, we have been having losses of around 17 to 20 crores for last 2 quarters. So if I again looking at the business construct, you had a Sena which always earned double digit, Suprajit Automotive earning 16 to 20, and LDC also last few quarters the trend has been more towards mid single digit and above. So this drop in EBITDA is driven by what? I mean, if you can give some perspective, the quantum of one-off expenses which we incurred in H1 or Q2, it will kind of help us understand the true business margin.
Agree. I think there are both factors. I think, first of all, the deceleration in non-automotive is certainly a major part why the margins have been affected. It is affected more significantly in Westcon, but it has also been equally strong in LDC. For example, in LDC itself, of course, I'll come to that consolidated number a little while. LDC also has got about nearly 30% of the business was in non-automotive. That has also taken a hit, and Westcon has taken a hit. I think that's the two places where significant margin erosion has happened, which is why that number what you mentioned has actually happened. But let me also make a general comment. Now I think slowly we are losing this SENA, LDC, SAL, SCU color, because the way we have started working now, I'll give you a few examples as well. It is working as a single division, not as separate entities. We are not looking at now what is the margin at SENA or what is the margin at LDC. We are looking at what is the margin at the controls division and what is the margin for the group. Few examples. For example, PMI warehouse, what Mohan mentioned, was for Suprajit Automotive. Now, what we have done is that there is an additional expenses to run a separate third-party thing. So, in Brownsville, we had an LDC warehouse. So, we moved everything into LDC warehouse. So, in the process, as a group, we are getting additional margin because we are not going to pay to a third party. I'm just giving one example. Another example, we have been underutilizing LDC's plastic molding capacities. So Westcon was buying a lot of plastic parts. So a lot of those vendors have been moved out, and those multiple components, probably 100 parts, have been slowly but steadily being moved to LDC. We had a problem with Hungary. I'm giving few examples. With one big business where they had negative margin. Just recently, it has been started moving to our SAL, where we still are making some margin. So as a group, we'll get a better synergy. So this Suprajit Controls division will become a single entity by itself, and it will not have pieces of LDC and SENA in the next year or so. So because we're working out the total synergies together. And in the process, there are some expenses. For example, PMI, we had to pay them 1 year or whatever rental because it has been committed, but we are forced to move. So there's a one-time expenditure. We are doing it. I mean, China movement, we are paying 2 rentals till whatever time because, we are forced to move, but we still have to pay rental to the previous, landlord. I mean, these are all not small costs. These kind of expenses are, for example, in Luxlight, or of course, it's unrelated to this part of the business. There are expenses which is running for shutting it down. So multiple such events are happening. And then added to that, one of the reasons why also, for example, some extent controls division margins come down is a simple thing on a customs duty. We were asked to pay a much higher custom duty, thinking that the component itself is from China. Of course, we have now filed a appeal and we are confident of winning. But till such time we win it, we have to pay the custom duty. So it hits the P&L. I mean, these are the things that kept happening in this quarter. That's why we have seen some changes. But I think given another couple of quarters, I think all these things will settle down. And I'm pretty sure things should be much better than what it is today.
Is it possible to quantify the impact in H1 because of these additional expenses and restructuring? And I'm sure there will be furthermore restructuring expenses. So
there is, it's an ongoing. There is an internal. I'm sure there's an internal data on what it is, but we have not really been sharing it to the outside world. But I think till end of this year, there will be ongoing this restructuring costs. But I think that's when it will all probably taper off.
And in the interim, do we see any need for infusion or any lending support to the subsidiaries?
Not really. We are fairly well funded. I think we also have good banking limits. So, if they need few millions here and there, we'll always support. But I think it should be okay.
Okay, I'll come back in queue. Thank you.
Thank you. The next question is from the line of Amit Hiranandani from SMIFS Limited. Please go ahead.
Thanks, team, for the opportunity. Happy Dhanteras and Diwali to everyone. Sir, my first question is basically, how much CapEx we are planning to do in FY24 and FY25, and where are we going to spend this amount?
Mohan, will you answer that?
Sure. Like we had already told last time, we are working with a budget of about 140 crores for this year. And the 6+6 that I was looking at very recently indicates that we should be well within that at ballpark for 140 crores. There would be some reshuffling in investments and what we had originally perceived to what we are going to do, but these are minor changes, nothing great.
Okay. Can we assume this similar amount in FY25 as well?
Ballpark, yes.
Okay. Sir,
actually, just to clarify, I think what Mohan said is that's actually part of it gets spilled over to next year also. This is a ongoing CapExes. So we'll again be reviewing next year and we'll be coming out as to what will be required for 24-25 and onwards, I think. Yeah.
Sure. Sir, second is basically continuing with the previous participant question on the one-off expenses. So any broad number can you throw? What was the one-off in H1, and how much more one-offs expected in H2 because of China plant relocation and refine other restructuring exercises?
I think I don't have that number with me. Maybe you can connect with Medappa later on.
Sure. Sir, second question is basically on the wanted to understand the reason for PLD's margin improvement and how much of this is sustainable.
That's an interesting question. I think quite a few were quite concerned about PLD division itself 3-4 years ago. A couple of years ago, or I don't know, maybe 3 years ago, it was a hot subject with the LED penetration, what's going to happen to the division. And we have kept on saying, giving a couple of years time, we should be getting back to double digit. And we had a clear plan of restructuring the entire division, and we have gone through that and not completed. There is a little more, another couple of quarters or till by March end. The tail of the restructuring is being done now. So what you are seeing, if you look at the last 3 quarters average, we are in double digit. This is what we have said. When we are in a low single digit EBITDA, everybody questioned our ability to grow the business or our ability to go to double digit. And I think that is the wonderful teamwork that we have been able to do by our Phoenix Lamps division, and it is now not only growing in a shrinking market, but also the margin improvement. As I've said earlier, a couple of years ago itself, the double digit is the target, and we have reached it on a fairly consistent basis, considering 3 months average or 3-quarter average. And we expect that to continue going forward. And we are also expecting, that business will be stable and probably will also grow because of the global requirement. It's a last man standing position. And I think that will continue. And just to answer some of the questions that is raised earlier, I think Suprajit Controls division is also eventually will be a story like that. I think we are confident that the business we know customer wants. There are very, very few players who have got a global reach, global manufacturing footprint, global engineering footprint. I can only talk about one other than us having such a reach. So in this business of high competitive thing, those who have strong market presence, geographical presence, and of course the financial strength are the one who will sustain this race. I think the same story will pan out for Controls division as well.
Oh, great, sir. Good to hear about this. Sir, another is on the UAW.
Sorry to interrupt, Mr. Hiranandani. May we request that you return to the question queue? Thank you. Ladies and gentlemen, in order to ensure that the management is able to address questions from all participants in this conference, we request you to limit your questions to 2 per participant only. The next question is on the line of Kashyap Zaveri from MK Investment Managers. Please go ahead.
Hello.
Yes.
Yeah, thank you so much, sir, for the opportunity. I have my 2 questions are, question number 1 on margins. You mentioned about looking at now, that SCD division, Supreme Controls division is now 1 unit. But if I look at within that, our margins on exports from India seem to be expanding quite well. But the contribution of that piece in the total business within SCD is still much lower than what Westcon plus LDC contributes. So eventually, when does what you are mentioning about double-digit margins? When does that happen? How many probably quarters or years that's still away from here? And within that, in the export division from India, margins have seen a fairly sustained expansion. So what's driving that? So that's question number 1. Second question is to, Akhilesh, in terms of Suprajit Electronics division, what's the order book at this point of time and what is the execution timeline?
Akhilesh, you want to talk about electronics division, generally the business and the execution times and ramp-up times?
So I'll just state that, we have done a one-time disclosure of the order book last quarter. You can refer that order book. I think that has not really, there's not been anything that's changed in that because those businesses are now going into production.
Okay.
What's interesting to see is that there were a lot of good businesses that got productionized even earlier than expected. And, for example, some of the three cluster businesses that were going into production have been delayed and are going to start in this quarter. So, I think we've been executing on that order book. With the kind of growth that we have, our complete focus is currently on execution rather than building the order book even further. We'll see great growth in this year.
Sorry, just one clarification. This 150 CR which was mentioned last quarter, these are annualized order or this is total order book?
Sorry?
I didn't understand what the question was.
Okay. So this is 150 crore which was disclosed in the previous quarter.
Yes.
Is the annual business or this is total business which is executable over certain?
No. It is the businesses one where when it goes into full production, its annualized value was that.
Okay.
It is not the lifetime order, no.
Okay, sure. On the margin side?
Yes. On the margin side, I think you are right. I think currently the Suprajit Automotive margins are quite healthy and strong. And that is the model of, Suprajit Europe front-ending and Suprajit Automotive manufacturing. In fact, I can say that the maximum traction or significant large traction of our future business is in that, part of the business, which is growing quite well. Having said that, the other businesses are also being won, whether it is for Metamoros, whether it is for Westcon, or whether it is for Hungary, they are also won. But in terms of the concentration, I think that this part of the business is getting the largest concentration.
And so just one clarification on that, as this division functions as one, and probably there are services which can be rendered from India to, let's say, LDC and Westcon put together. The shift in revenue can be seen within SA division from overseas ops to Indian ops?
Yes, I think I just mentioned, one of the business out of Hungary, we just started manufacturing out of India because there is no margin considering obviously, Hungary employee cost and operational costs are much higher.
Okay.
The problem with all this movement is that, customer approval takes a long time. And,
right.
Customer also wants a piece of the pie if you want to move to a lower cost region, as you know. So, it's a thing. So the first large business has been moved actually. And I think that is the kind of stuff we are talking about in terms of, the restructuring when we said. I think that is very much part of that.
Let me add to that, if I can. Look, I mean, what we've seen is that, till now we've had a lot of good exposure on the Europe market. Now with the SCD team being one of the leaders in the US market, we've got great exposure in the US as well. So some of the biggest contracts now that we're seeing are all, either US-based cable businesses coming to India or even actuator businesses that are now being seen that we can be one of the first few actuator knowledge and capability who can do it out of India. So these are the kind of two big drivers that we will see in the next few years. I think definitely in the next couple of quarters we should have good updates on all these kind of business wins as well.
And added to that, I think what we are also doing is a general point. The part of restructuring is also that lot of back-end work we have started doing out of India. The engineering work, for example, or the design work, for example, simple engineering work to actual design work. I think, Indian engineers are as good as any in the world. So a lot of engineers, there's a few of the engineers who are working and doing, let's say, CAD work or a design work out of US. They are now becoming a front end for us to customer interactions, and the back end is entirely done by our team, whether it's in FTC or our SAL engineering teams are working with them. So there's a lot of internal synergy, what I would say, tapping happening. But they're all, long, not an immediate term, but this is a journey. Given few quarters, I think we'll see all these effects falling into the operational margins.
Sure. But just one thing, as this transition happens, can we reduce the cost in terms of fixed cost in the ex-Indian ops within, Suprajit Controls? Do we have a plan, and is it easy to reduce the cost over there because more business will shift to probably SAL?
I think, it all depends how fast and how soon that happens.
Okay.
There would be some fixed cost reduction possible in terms of people, but
okay.
Infrastructurally we'll continue to have these places because customers still wants onshoring. I think, there is still a concern on offshoring.
Okay. Sure. That's it from my side.
We should also get a lot of synergies from, this one PLM and ERP plan, right? Then we will be able to do a lot more back-ended work in India, where right now these ERP systems are based and supported out of these global operations.
Okay. Yeah. Thank you so much, sir. That's it from my side. Thank you.
Thank you. The next question is on the line of Ashin Modi from Equirus. Please go ahead.
Yeah, hi, thanks for the opportunity. So my first question is related to the products at the Suprajit Technical Center. So we have said that we've got few orders from the instrument cluster side. So could you please help us understand whether those would be LCD or those would be TFT and what sort of product are we supplying over there? And also we are saying of supplying few actuators and bringing electromagnetic actuator to India. So to where we are supplying that and what is the scope over there?
We cannot specifically talk about specific customer, but Akhilesh can answer both the questions.
Yeah, sure. So right now in India, generally there's not many two-wheelers going with LCD and TFT clusters. So we have one current running business in the TFT cluster side and a couple that are in the pipeline. The rest of the business is more on the LCD and various types of, let's say, lower-end clusters just below the TFT. So both LCD and what we call semi-digital clusters. In the actuator space, again, this is one of the big reasons we won this business is because of showing the experience we had in LDC of actuators, and that's why we won the business in India, even though we had no past actuator experience. And we won, business in seating actuators, in steering lock actuators, in charging gun actuators, all for two-wheelers. And we're also now working with a few passenger vehicle customers for some of their new models for seating type actuators, just like we have in LDC.
Okay. So this penetration of actuators would be pretty less in the country, right?
Sorry, I can't hear you properly. Can you speak a little louder?
I'm saying the penetration of these actuators within the two-wheeler and passenger car segment would be quite lower in the country, or are we gaining market share?
Akhilesh, yeah, go ahead.
Yeah, no, I would say that the actuators in general, it's actually actuators are a much higher price replacement of a cable-based mechanism that we were already doing, like a seat lock actuator was done with a cable and a lever, and now it's with an actuator. There's not much penetration right now in terms of the total number of customers using actuators for this because it's a higher cost replacement. There are not many customers using it. So I'd say within that, we have a good market share because I think we're basically one of the leading OEMs in terms of technology and, and also in terms of volume for these kind of actuators. So I would say in the two-wheeler space, we'd probably be having a good leading kind of status in the market right now for actuators.
Okay. Thank you, sir. I'll join later.
Thank you. Ladies and gentlemen, we request you to limit your questions to one per participant only. We'll move on to the next question. That is on the line of Senthil Manikandan from iThought PMS. Please go ahead.
Hi, sir. Good morning. Just first question is on the domestic cables division. So in the press release, you mentioned that total India business has grown around 1.5%. So over a medium term, So how should we look at the growth prospects for the domestic cables division? So will there be drivers like increase in content per vehicle is possible? So something on that line. Thanks.
Mohan, will you answer?
Sure. When we talk about domestic cable division, there are three parts to it, if I can split that question. One is the cables that we are supplying to the two-wheelers. Now that will by and large follow the market. Whatever the market growth happens, to the same extent we will be able to grow. To a certain extent, we would be getting some market share here and there, and that would help us. Now, the second portion to it is we are growing into cable space beyond two-wheelers. That means basically manufacturing it for passenger car vehicles and CVs. So to that extent, it is going to add to our growth rates, which is going to be beyond the two-wheeler growth rate. And the third part of the story is that we are talking about beyond cables. That means we are looking at mechanisms and products which go beyond cables, but into two-wheeler predominantly. Therefore, these three put together is where we are looking at how we can grow this division.
Thanks, sir. Just second question with respect to the Suprajit, the electronics division. So, in terms of digital cluster, is there any, how is the competitive intensity over there? And so over a long term or a mid to long term, what would be the market size? And you can share some aspirations on the market share.
Mohan, will you take that question?
Yeah. Again, I would always want to, cut the elephant into pieces before I start chewing it. Therefore, let me start by telling that when we are talking about clusters, we should be talking about two portions. One is the ICE portion, where there are established players who are already supplying. Then there is the EV market, where we have equal opportunity, so as to say. Now, our long-term vision is that we need to be in a pole position when it comes to the EV segment, because we are working with multiple EVs, and they are also in their nascent stage, and they are also growing. And our idea is to have the foot firmly in the door so that we are gaining the entry there. Therefore, acceptance again here would become easier with these kind of OEMs. Whereas when it comes to ICE players, it is going to take more time. It is a long drawn way that we can penetrate into the market. But we definitely see ourselves gaining reasonable market share. But would it be a predominant market share? The answer is no. But would it be a reasonable market share? The answer is yes. Whereas in EV, we are looking at a predominant market share. I hope I have answered it.
Yes, sir. Thanks. That's it from my side.
Thank you, sir. We take the next question from the line of Gokul Maheshwari from Agvira Capital. Please go ahead, sir.
Yeah, thank you for the opportunity. Just on the domestic two-wheeler business, the industry is at the premium end growing while the entry level is not growing. So from that angle, do we get any benefit with respect to premiumization in the industry?
I think, let me put it this way. As it becomes premiumized, there's probably one or two cables also won't be there, whereas the cost or price per piece of cable probably will be higher because the expectations of performance is also goes up. So, and overall, I don't think there's much of a change. Having said that, I would say that it's probably more neutral than anything else.
Okay, fair. On the braking product, you mentioned in the press release that you are now putting money behind in terms of commercializing this.
I can't hear you properly. Please.
Yeah.
Can you speak louder?
Am I audible?
Now, yes.
Yeah. In the press release, you mentioned that the braking product you are now putting into commercial operations in terms of putting money behind creating capacity. So can you just give an overview with respect to the business win and how much would this capacity be for this particular customer or customers?
Mohan, will you take the question? Or Akhilesh, anyone? Okay.
Yeah, between us.
Mohan, go ahead.
Yeah. When we are talking about commercialization, what we are doing is we want to keep it as much as possible as asset light. However, having said that, there are some OEMs who are wanting us to have a depth of manufacture. Therefore, we need to balance between these two. Therefore, what we will be doing is we will definitely be, there would be certain amount of investments bringing in the depth of manufacture, but we'll have to take a conscious decision between on what we call as a make-buy decision. So that's what's going to happen. Specifically with respect to the capacity that you asked for, why I'm alluding to that is, when it comes to the process, then the process-based capacity probably we will be investing a bit more, which would be across multiple customers, multiple lines. Whereas when we come to the assembly-specific product lines, it would be tailored to the projections that the OEMs have made. So there is no one single answer I can give, so much is the capacity, but it will be at the process level defined differently, at the product level defined differently.
Understood.
To add to what Mohan said, I think, we think that braking related products would be one of the areas where we are going to concentrate. And, recently last year, as you know, we restructured our aftermarket into a single large place. And that has actually released one of our plants for any of the, use. So we are converting that into a space for setting up some of our braking products at the moment. And at the same time, we are also looking at additional space, as we have made in the announcement, that we are looking for additional, infrastructural facility to house some of the projects that we are in the, late stage of negotiation with customers for commercial orders. So I think there is quite a few interesting things happening in that space, and we are getting geared up for that.
Great. Lastly, just on the global industry environment.
Mr. Gokul, may we request you to join the question queue, sir, as we have several participants waiting for their turn.
Sure, no worries.
Thank you. A reminder to all the participants to limit their question to one per participant. We take the next question from the line of Jinal Seth from Avida Capital Advisors. Please go ahead.
Good morning and happy Diwali to the entire team. Am I audible?
Yes.
Great. Okay. So my question is that, now considering the fact that they're a global business, what I wanted to kind of understand is internally, how do we plan, think for, how does the management plan and think for uncertainties? And obviously we've had learning. So wanted some thoughts and views from your side.
I'll let Mohan to give his thoughts. Maybe I'll add something more on that. Mohan, on our global business and how we are planning to deal with it.
Yeah. See, one thing about running business is uncertainty. And I would say that at the end of the day, there is an area of concern and there is an area of influence. In an area of concern, now let's say there is a war in Ukraine, and say area of concern, you and I can't do anything about it, so we need to manage the situation. If there is a failure of monsoon in India, or there is a weather pattern change happening across the globe, there is little that we can do about it. So that's an area of concern. But if we look at the long-term trends, we use that area of concern and bring it into an area of influence as to what we can influence within our businesses. So that is the way we always look at it. For example, I'll just give you I will substantiate it with an example. Now, let us say Euro 7, Euro 8 norms are going to come because of the environmental challenges that are coming. So what could be an impact for our business, or do we see a business opportunity over there? That is the way we look at it, and we start preparing ourselves. So this is one way of looking at it. There are certain other areas where we will definitely not be able to predict it. But to a certain extent, we do what we call it as a risk analysis. So we have a risk committee. We sit with the risk committee. We make an assessment. And to those which has got what we call as RPM, high RPMs, or the risk priority numbers, what we do is we prepare some sort of an action plan as to what we can do to stay away from this risk. This is the way we manage risk, so as to say.
And also from the more from the system point of view, as Akhilesh was mentioning, when you get into a single ERP, single PLM, a lot of things gets connected and responses become much faster for our where we can influence kind of a situation. Global business is different in different countries and different geographies, but ultimately we work with systems and processes. I think it should be possible, and it is possible to monitor and also reasonably control well. And we have a system where we have our annual budgets, our mid-year reviews, our monthly meetings, where we constantly monitor their performance on a regular basis. So, I suppose that way we are generally in the picture everywhere, so that we are able to understand and do what is required as and when it is necessary as we do the business with all these geographies.
Thanks, and appreciate your response. And my last question is that, considering the fact that the global industry environment is tough and we were already seeing consolidation, so is there any further exits or reduced competition from our weaker competitors?
See, I think, this is a similar situation I think I sort of elaborated a bit earlier. The situation at Phoenix Lamps was a similar situation where there were excess capacities, and some people folded up, and slowly and steadily the color turned. Those who are good manufacturer, value for money product capable suppliers who had the reasonable balance sheet to fight this kind of a battle in this what I would call as a dog-eat-dog market. I think they come out well. I mean, it's the same thing. Is there excess capacity? I'm not talking about cable. I'm generally talking about auto components. I think is there too many suppliers? Yes, the answer is yes. Is there consolidation? Yes. I mean, we ourselves have done 5 cable asset purchases. So it's happened elsewhere also. So number of suppliers will come down. And in the long run, there can be only 4 or 5 good global suppliers. Right now, it is a lot more than that. Having said that, these smaller guys who are in 50 million, 40 million, 80 million of cable in terms of revenues, they don't have the full geographic reach. They are in part of the world, somewhere in half part, somewhere warehousing, but they are having big problems in terms of being viable and being profitable. So I think slowly and steadily that breed will either get sold or go out of business, and that's when I think the stronger players like us will get these opportunities to further improve on what we are doing now.
Thank you, and good luck to the team.
Thank you.
Thank you, sir. A reminder to the participants to limit their question to 1. We take the next question from the line of Mr. Viraj from SIMPL. Please go ahead with your question, sir.
Yeah, just 2 questions. One is on the global controlling division. So the kind of restructuring which we talked about. So if you look at the first half, we did something like mid-single-digit margins at the EBITDA level. Post these restructuring, so if one has to understand the journey towards double-digit, would a large part of the improvement come from the cost restructuring part, or in terms of, or it will be more driven in terms of the recovery in sales and the new order wins? So that is one. And second, if you can just give some perspective in terms of the retrofit business, LED retrofit business, which we did either on a full year basis in 23 or in the first half.
Okay, I'll answer the first question, and second I'll probably pass on to Mohan. I think the point is simple. For example, I'll just give a ballpark number. What can our Matamoros plant can produce? It can produce up to, let's say, 10 million a month or 8 million a month. What are we doing? Let's say 4 million a month. So what happens is that when in the process, what I've said is the consolidation phase, as we get more and more business, our fixed overheads gets amortized on a much, and the margins improve. As we go forward with the competition not being able to fight the war, and as our volumes grow, our purchases and operational efficiencies improve. That is where the margins will add. So I think there are multiple things that will drive it. And of course, there is a lot of businesses will be made out of India, which anyway is probably amongst our group is the lowest cost operations, that will add extra to the margins. And then we relocate businesses to customers' requirements or customer cost requirements. That will, let's say, I just mentioned about moving something from Hungary. Maybe we'll move something more from Metamoros, where margins are, let's say, very small or non-existent, and maybe we'll easily get some margins out of India. So there's quite a bit of churn that's going to happen, but the trajectory is as the volume grows, as we do the restructuring, whether it's a year or 3 quarters or 5 quarters, I think the margin profile has to improve and will improve, and so is the top line. I think that is what we are expecting to do in the controls division. In terms of the LED retrofit, I think I'll ask Mohan to answer.
Yeah, sure. Basically, when we tested the waters, we tested the waters in our area of strength, which is the two-wheeler bulb market. That's where we introduced the drop-in solution of LED. And that retrofit, or the drop-in solution as we call it, we had some lessons learned, and we saw how the market is reacting, both in terms of pricing elasticity and also in terms of the technological improvements that we need to do. Having stabilized that, very recently, just about a month back, we introduced a new set of retrofits for passenger car vehicles. So our idea is that we need to cover the entire range, starting from a two-wheeler to a three-wheeler, two-wheeler, three-wheeler combined, I would say, and then move to passenger car, which we have started just now, and finally move into the CV segment. So we would be having a complete range as Phoenix in the marketplace, in the aftermarket.
So when you say retrofit, is it largely DRL or these are proper fully LED?
They are not DRL. They will have exactly the same mount like what a halogen bulb has a mount. There are trade calls it differently. You have H4, H12 like this. There are different way, H7. So we have these different mounts. So what we do is we give the same mount, but instead of a halogen with the filament there, we put the LED there, but we will also have a driver circuit there. And again, when we put the driver circuit, the technicalities, whether it is able to handle AC and DC and these kind of things. Can it handle the spikes? Because in Indian conditions, it's going to be completely different in terms of robustness that would be needed.
Okay. Any sales number?
I'm sorry to interrupt, Mr. Viraj.
Yeah, I think we are already 12:04. We will take 2 more questions, I think, then we will wrap it up, if there are questions.
Yes, sir. We take the next question from the line of Mr. Ravi Purohit from Security Investment Management. Please go ahead, sir.
Yeah, all my questions have been answered. Thank you.
Thank you, sir. The next question is from the line of Kashyap Zaveri from MK Investment Managers. Please go ahead.
Sorry, my questions have been answered.
Thank you, sir.
If there is no other question. Okay, go ahead. We'll take some.
The next question is from the line of Mr. Rakesh from Axis Capital. Please go ahead, sir.
Yeah, thank you, sir. Just one question. If you can quantify what has been the overall impact of restructuring operations in our EBITDA, at what level was that? And going forward with this all transition going on in your restructuring operations, let's say, another 2 quarters restructuring expenses will come in. What kind of, impairment we can expect, or will there be any impairment of the plants which you are exiting? And secondly, what are the break-even levels for the new plants where you are transitioning this operation? Thank you.
No, in terms of the impairment, it's difficult for us to say. I think only when a restructuring is complete, we will know whether there is an impairment. Maybe end of March is one time when we'll look at any impairment, if at all. So it's difficult to answer that. In terms of the, I would say, cost of quantifying, it's an ongoing exercise. For example, we are now restructuring in China. We are moving from one place to another place. All those costs are actually on the P&L, and they have been booked as and when they are doing. Some of them are not tracked in that sense. The bigger one, probably we know what is the cost. We'll have to pay lease at the existing one. We have to pay the lease at the new one. We have to pay power here. We have to pay for power there. Those kind of things are quantified. So there will not be an exact picture, but there may be some information. If maybe you could get some more color on this offline with our CFO, maybe he will be able to answer that question.
Sure, that's helpful. And one last question, sir. Sorry if I missed out on that. With this decline going in the non-auto side, will there be any shift of your capex program for this year and next year?
I think Mohan has already answered that. The capex, as earlier disclosed at 140 crores for this year and part of next year, is still holds good. And I think there will be some reshuffling within that 140 crore, but the overall number remains the same.
Okay. Thank you so much, sir. All the best.
Thank you.
Thank you. Ladies and gentlemen, we take that as the last question for the day. I would now like to hand the conference over to the management for closing comments.
Yeah. First of all, thank you all for patiently coming to, listening to our comments on our quarterly as well as half-yearly number. Thank you for your interest in Suprajit. I again wish you all a happy Diwali and Dhanteras, and look forward to again interacting with you in the next quarterly meeting. Thank you very much. I hand over back to the moderator, please. Thank you.
Thank you. On behalf of Anand Rathi Shares and Stock Brokers, that concludes this conference. Thank you for joining us, and you may now disconnect your line.
Thank you.